Well, it started off with the problems in the subprime lending market. As many people know, a lot of mortgage lenders made a lot of bad loans. Those loans were packaged and resold to people who didn't understand how really bad they were. And when it turned out that there were a lot of bad loans, people lost a lot of money. And now we have a problem with many financial institutions became insolvent. Now, what had been an economic challenge has turned into a panic, in that when Treasury Secretary Paulson took over Fannie Mae and Freddie Mac, he set off what I call the Paulson panic, that the clumsy handling of these institutions sent a message to the rest of the world that the financial assets were worth a lot less than people thought they were just a few days before. That set off a panic. If Fannie Mae and Freddie Mac were as bad as the administration said they were, then by implication, the other institutions holding those mortgage-related assets were also in trouble. And then we saw, the failure of Lehman Brothers, AIG, and suddenly everybody goes, wow, these institutions that we thought were in good shape a few days ago are in bad shape. Who else is in trouble? Now, this has set off a global panic where everyone is afraid to lend to anybody because they don't know who can pay them back and who can't. Now, when this happens, we have a general starvation of credit, where even good creditworthy borrowers are having trouble getting good loans when they need them. This means that the business that wants a loan to get a piece of equipment to expand is having trouble doing that. This means that people who want to buy a house are having trouble getting a mortgage loan. And so this is why we see what had been a routine downturn turning into a panic. The logic behind the plan is this. We don't know yet how many of these mortgages are going to go really bad or not. It'll take a year or two to determine that. So there's this big uncertainty, this big black cloud hanging over many financial institutions. By taking that uncertainty out of the banks and into the government, we resolve the problem much faster, and we can figure out which banks are alive and which banks are not. In that way, we can get back to the business of getting good credit to good borrowers who need it. My thoughts on the rescue package are that a lot depends on the implementation. That it's a nice idea to resolve the uncertainty faster by getting the bad assets off the books of the banks so that the banks can get back to the business of lending to good borrowers. How that will be implemented by a new administration remains to be seen. We have many serious economic challenges facing our country. We have the fallout from the housing bust. We have the credit crunch. We have the fallout from $90 a barrel oil. We have a lot of serious issues facing us. An aging population, we've got problems with Social Security, with Medicare. These problems did not start overnight. They're not going to go away overnight. But we also have a hardworking, well-educated, innovative, entrepreneurial population, and we've dealt with many challenges before. So these are challenges that we're going to, we will overcome. It's going to take some time. That there's no magic bullet. It's not as if one piece of legislation is going to fix everything quickly, but the government now has the tools it needs to fix the situation. That the Fed has the authority to do what it needs to do. The Treasury has many tools. I view the rescue package as a big mop to kind of mop up the damaged assets. We have the HOPE program that will help restructure $300 billion worth of mortgages. So there are plenty of programs that have been passed within the last few months. Now it's a question of implementation. I'm an expert on financial markets. I've been to over 50 stock exchanges around the world. So I get a lot of calls from reporters about, hey, did you see this new NYSE rule filing? Or, this exchange bought that exchange. What do you think? I do a lot of research in short selling. And since the SEC has recently tried to ban short selling, I'm getting some calls on that from more specialist places that follow security markets really closely. I get, since I teach financial crises here at Georgetown, I've been getting a number of calls about, the rescue package, the crisis du jour, what happened in the market today type of stuff. So the question is, what is the role of the Federal Reserve? Congress created the Federal Reserve System and it can change it at any time. However, Congress, in its wisdom, decided to create an institution that was partially insulated from partisan politics. So therefore, it is set up as a system of 12-member banks where the banks have a lot of say in their organization, controlled by a board of governors appointed mostly by the president, and with terms that go beyond any one president's administration. So this semi-independent body creates those things that we carry in our pocket called Federal Reserve notes. So if you look at the money in your wallet, it says Federal Reserve note on it. And the Fed basically decides how many of those to create, and they can create as many or as few as they want. If they create too many, we have inflation. If they create too few, we go into a recession. So the Fed is always between a rock and a hard place, trying to figure out exactly what's the right number of those to create. Now, the Fed is also a banking regulator. It's their job to make sure that the banks don't fail. So when the banks get into a liquidity crisis, the Fed can lend them money to keep them from running out of money. So it's their job to prevent banking panics, to prevent runs on the bank.